Gold and silver are not rising because investors suddenly became emotional or fearful. They are rising because the global pricing system is signaling that uncertainty is no longer a temporary condition, but a structural input. That distinction matters, because markets can fade fear, but they cannot fade structural uncertainty without repricing risk. The recent surge in precious metals is being mischaracterized as a reaction to headlines, when in reality it reflects a deeper recalibration of how capital evaluates durability, liquidity, and policy credibility in a system that is losing its ability to anchor expectations. What looks like momentum is actually reallocation. What looks like speculation is risk management. And what looks like a safe haven trade is, increasingly, a statement about confidence erosion across multiple layers of the financial architecture. The strength seen at the start of the week was not accidental or impulsive. A move of that magnitude, especially in gold, does not occur because traders wake up optimistic. It occurs when positioning is already light, when optionality is mispriced, and when the cost of being underexposed suddenly exceeds the cost of being early. The market was primed for a repricing long before the catalyst arrived. The catalyst merely removed the last excuse to delay it. The escalation surrounding Venezuela functioned less as a singular geopolitical event and more as a reminder of how fragile the energy financial nexus remains. Oil-producing regions are not just geopolitical chess pieces. They are inputs into inflation expectations, fiscal stability, and central bank credibility. When uncertainty emerges around control, continuity, or conflict in those regions, it feeds directly into assumptions about future price stability. Precious metals respond not because of fear of conflict itself, but because conflict injects noise into policy forecasting. Central banks can manage inflation. They cannot easily manage uncertainty. That uncertainty forces markets to widen probability distributions around future rates, future growth, and future stability. Gold and silver thrive in widened distributions. The sharp move higher early in the week was therefore less about Venezuela, specifically, and more about the recognition that global risk is becoming harder to compartmentalize. Regional disruptions no longer stay regional. Energy markets, shipping lanes, insurance costs, and fiscal balances are too interconnected. As soon as one node becomes unstable, the system absorbs that instability everywhere. That absorption shows up as demand for assets that do not rely on promises of future policy coherence. Gold's outsized single-day gain was not an anomaly. It was the release of pressure built during months of suppressed volatility and one-sided positioning. Silver AS stronger percentage move reflects the same dynamic amplified by its thinner liquidity and dual role as both monetary and industrial input. When uncertainty rises, silver behaves less like a commodity and more like a leveraged expression of monetary doubt. That is why its volatility is not a sign of weakness, but of sensitivity. The midweek pullback following strong manufacturing data illustrates another critical misinterpretation. Markets briefly flirted with the idea that economic resilience would delay monetary easing and risk assets reacted accordingly. But that reaction was shallow and short-lived because the data did not resolve uncertainty. It merely complicated it. Strong manufacturing alongside rising geopolitical risk does not simplify the policy path. It makes it harder. Central banks facing resilient demand but fragile external conditions are forced into narrower corridors of action. They risk over-tightening into instability or easing into inflationary resurgence. That dilemma is precisely what precious metals price. The quick recovery after profit-taking signaled that sellers lacked conviction, not that buyers were euphoric. Sellers acted tactically, buyers acted structurally. That difference defines trend persistence. When Friday's employment data disappointed, the narrative snapped back toward easing expectations. But again, that was not the core driver. The market is no longer trading single data points. It is trading the loss of clarity. Rate cuts may come sooner or later, but the path is uneven and politically constrained. Fiscal pressures remain elevated, debt servicing costs are rising, and geopolitical risk constrains global coordination. In that environment, Gold AS weekly gain is less about betting on a dovish pivot and more about hedging against policy oscillation. Oscillation erodes confidence faster than any single policy mistake. Silver's parallel movement, with greater intraday violence, underscores how smaller markets internalize that erosion more dramatically. Analysts pointing to additional upside in silver relative to gold are implicitly acknowledging that silver remains underowned relative to its role in both monetary hedging and industrial demand. The compression of the gold-to-silver ratio is not a speculative curiosity. It is a structural adjustment. Ratios compress when markets reassess relative scarcity and utility. Silver's narrowing gap reflects its growing importance in a world that is simultaneously electrifying, fragmenting, and deglobalizing. Industrial demand is no longer a cyclical tailwind. It is a strategic baseline. At the same time, silver's monetary attributes reassert themselves when trust in policy coherence weakens. This dual pressure is rare and destabilizing for traditional valuation models. Historical support levels on the ratio are less important than the trend itself. The market is signaling that silver is being re-rated, not just repriced. This re-rating does not require extreme outcomes like those seen in past bull markets to be meaningful. It only requires sustained recognition that silver's role has expanded while its market depth has not. Gold, meanwhile, is fulfilling its role as the system's barometer. Its steady accumulation of gains across weeks reflects not excitement, but acceptance. Acceptance that volatility is not an anomaly to be arbitraged away, but a condition to be managed. When gold holds gains after profit-taking and ignores short-term data noise, it is telling you that the marginal buyer is not chasing performance, but ensuring balance sheets. That buyer does not disappear on a strong print or a hawkish comment. That buyer scales. The coming CPI release will be framed as decisive, but its true importance lies in how the market reacts, not what the number says. If inflation cools and metals hold, the market confirms that uncertainty, not inflation, is the driver. If inflation surprises and metals rise further, the message is even clearer. Either outcome reinforces the same structural thesis. Precious metals are responding to a world where economic strength, geopolitical fragility, and policy ambiguity coexist uncomfortably. That coexistence is not transient. It is becoming the default. And in such a world, assets that sit outside the promise-based system do not need a catalyst to perform. They need only the absence of resolution. What is quietly changing underneath this price behavior is the way capital interprets resilience. In prior cycles, strong data was treated as an antidote to defensive positioning. Growth meant risk on, and risk on meant rotating out of hedges. That reflex is weakening because resilience now carries a different implication. Strong data in a fragile system does not remove risk, it concentrates it. It increases the probability that policymakers are forced to choose between bad options rather than good ones. When employment remains firm while geopolitical stress rises and fiscal balances deteriorate, the margin for error shrinks. Markets sense that shrinkage long before it shows up in official guidance. Precious metals respond to the narrowing of policy bandwidth, not simply to the direction of rates. This is why gold and silver can rally even when the macro picture looks mixed, rather than outright negative. Mixed conditions are harder to manage than uniformly bad ones. They create volatility in expectations, rather than clarity. That volatility is what metals price. The persistence of gains across weeks reflects a reassessment of what constitutes safety. Safety is no longer defined by yield alone. It is defined by independence from policy sequencing. Assets that depend on a clean narrative around growth, inflation, and rates are exposed to whipsaw. Assets that do not depend on that narrative gain relative appeal. Gold sits at the extreme end of that spectrum. Silver, because of its hybrid nature, sits closer to the fault line. It benefits from the same hedging impulse while also being pulled by industrial demand that is itself becoming less cyclical and more strategic. This duality complicates its price action but strengthens its long-term case. The midweek selling that emerged on manufacturing strength illustrates how reflexive trading still operates, but its brevity shows how little conviction remains behind it. Participants sell because they are trained to sell on strength, not because they believe the trade is over. When those sales fail to attract follow-through, it sends a signal internally that positioning is no longer crowded on the long side. That signal encourages re-entry rather than caution. It is a subtle shift, but one that compounds over time. The market begins to treat pullbacks as temporary dislocations rather than trend reversals. That behavior is already visible. Gold AS' ability to maintain levels above early week closes, despite multiple opportunities to break lower, suggests that buyers are increasingly insensitive to short-term noise. They are not trading data. They are trading regime risk. Silver's sharper swings reflect the same dynamic with less depth. Its market simply cannot absorb flow as smoothly. That does not make it weaker, it makes it more revealing. When silver sells off harder on data and then rebounds faster, it is showing you where liquidity is thin and where demand is latent. Thin liquidity in a context of persistent demand is not bearish, it is unstable. The compression of the gold to silver ratio should be viewed through this lens. Ratios move when relative assumptions change. Silver's catch-up is not about enthusiasm, it is about recognition. Recognition that silver's supply profile is less forgiving than gold's, and its demand profile is expanding in ways that are less sensitive to cyclical slowdown. Energy transition, electrification, and defense-related manufacturing are not discretionary in the same way consumer demand is. They are policy-driven and capital-intensive. They do not turn off quickly. When monetary uncertainty rises, silver captures both sides of the equation. It hedges monetary instability while remaining embedded in industrial strategy. That combination compresses the ratio not because gold is weak, but because silver is being reevaluated. Historical ratio levels provide context, but they should not be treated as targets. The market structure today is not the market structure of past bull cycles. Above-ground stocks are different, financialization is different, industrial intensity is different. Comparing ratios without adjusting for these variables risks false precision. What matters is direction and persistence. Direction favors silver. Persistence suggests this is not a one-week anomaly. The broader implication is that precious metals are being repriced as a class in response to a shift in how uncertainty is distributed. In earlier periods, uncertainty was episodic and localized. Today, it is continuous and systemic. It flows from geopolitics into energy, from energy into inflation expectations, from inflation into policy credibility, and from policy into currency stability. Each link amplifies the next. Metals sit outside that chain. They do not eliminate uncertainty, but they are not amplified by it either. That relative insulation is what attracts capital during periods when correlations break down. The notion that metals are running on uncertainty understates the case. They are being repriced to reflect a world where uncertainty is no longer a shock but a baseline. That baseline forces investors, institutions, and even central banks to reconsider portfolio construction. Hedging becomes less about timing and more about presence. You do not wait for confirmation when the cost of waiting is exposure to compounded policy error. You maintain exposure because the distribution of outcomes has widened. This is why flows into metals can persist even when immediate catalysts fade. The Venezuela situation may evolve. Employment data will fluctuate. CPI will surprise or not. None of that resolves the underlying condition. The underlying condition is that the system is operating with thinner buffers and higher interdependence. Precious metals respond to that condition regardless of the weekly narrative. The strength observed over multiple weeks suggests that this recognition is spreading beyond tactical traders into longer-term allocators. Once that happens, price behavior changes. Rallies become more orderly. Pullbacks become shallower. Volatility remains, but it clusters differently. It no longer signals indecision, it signals redistribution. Capital is not leaving the space. It is rotating within it, adjusting exposure without abandoning the thesis. That is a powerful dynamic, and it rarely announces itself loudly. It shows up in exactly the kind of price action currently being dismissed as headline-driven. As this redistribution unfolds, it becomes increasingly important to separate surface narratives from structural drivers. Headlines focus on individual data releases, single geopolitical flashpoints, or short-term positioning adjustments, but those elements function more as triggers than causes. The cause sits deeper in the architecture of the financial system. Liquidity is abundant in nominal terms, yet constrained in functional terms. Balance sheets are large, but flexibility is limited. Debt levels restrict policy choices, and political fragmentation slows response time. In that environment, markets are forced to price not just outcomes, but the quality of response to those outcomes. Precious metals benefit precisely because they do not require confidence in response quality. They are not a bet on competence. They are a hedge against its absence. This distinction matters. When markets believe that policymakers can quickly and credibly neutralize shocks, capital prefers instruments that maximize yield or growth exposure. When that belief weakens, capital migrates toward instruments that minimize dependency. Gold has historically filled that role, but silver is increasingly being pulled into the same category, not because it has become purely monetary, but because the systems that rely on it are becoming strategically indispensable. This is where industrial demand stops being cyclical and starts becoming political. Supply chains tied to energy infrastructure, electrification, and national security do not respond to price signals in the same way consumer markets do. They respond to mandates, subsidies, and strategic stockpiling. That changes elasticity. When elasticity declines, volatility does not disappear, but it tilts upward. Downside moves become harder to sustain because buyers are less price sensitive. They are not optimizing quarterly returns. They are securing inputs. This is one of the least appreciated aspects of silver's current behavior. Analysts still frame it as a leveraged version of gold or as a high beta industrial metal. Both descriptions are incomplete. Silver is transitioning into a category where its marginal buyer is no longer purely financial. That transition is gradual, but markets anticipate transitions before they are obvious. The compression of the gold to silver ratio reflects anticipation more than realization. It reflects a repricing of future constraints rather than present shortages. That is why attempts to fade the move based solely on overbought indicators have struggled. Momentum traders see extended charts. Structural buyers see time. These perspectives do not reconcile easily, and when they collide, price action becomes erratic rather than directional in the short term. Over longer horizons, the structural view tends to assert itself. This does not imply a straight line higher. It implies a market that resists sustained downside even when sentiment temporarily cools. The repeated pattern of pullbacks that fail to break prior support levels reinforces this interpretation. Each failed breakdown increases confidence among longer-term holders and reduces the incentive for aggressive short positioning. That feedback loop matters because it alters the risk-reward calculus for participants who rely on mean reversion. When mean reversion becomes unreliable, positioning shifts from active trading to strategic allocation. That shift is subtle but powerful. It reduces turnover and increases price stability at higher levels. Stability at higher levels is precisely what makes metals more attractive to institutions that previously avoided them due to volatility concerns. Once those institutions enter, liquidity deepens, but so does the base. This is how markets transition from episodic rallies to sustained revaluations. The role of macro data in this process is paradoxical. Strong data no longer guarantees lower metals prices, and weak data no longer guarantees higher ones. What matters is how data interacts with expectations about policy credibility and geopolitical risk. The employment report that reignited easing speculation did so not because it was weak in absolute terms, but because it reinforced the perception that the economy is decelerating unevenly. Uneven deceleration is harder to manage than uniform slowdown. It complicates forward guidance and increases the probability of policy missteps. Markets price that probability, not the headline number. CPI will be interpreted through the same lens. A benign print may reduce immediate pressure, but it will not restore confidence if underlying structural pressures remain unresolved. Conversely, a hotter print may accelerate flows into metals not because inflation is rising, but because it constrains policy further. Either outcome sustains the relevance of precious metals as strategic assets rather than tactical trades. This is why commentary that frames recent gains as purely reactionary misses the point. The reaction is not to a single event. It is to an accumulation of constraints. Constraints on energy supply, constraints on fiscal maneuverability, constraints on diplomatic resolution, and constraints on monetary normalization. Each constraint narrows the path forward. Markets respond to narrowing paths by favoring assets that do not require precise navigation. Gold and silver fit that requirement. Their continued strength is less about fear spikes and more about adaptation. Capital is adapting to a world where uncertainty is persistent rather than episodic. In such a world, hedges become holdings. That transition is still underway, but its outlines are becoming clearer with each week that metals hold their gains despite shifting narratives. The resilience itself becomes a signal. It tells participants that selling pressure is being absorbed by buyers with longer time horizons and different objectives. Once that becomes widely recognized, behavior changes. Volatility may remain, but its character shifts. It becomes a mechanism for transfer rather than a sign of instability. And when volatility serves as a transfer mechanism, it tends to favor those who understand the structure over those who chase the noise. This is the environment that precious metals are now operating in, and it explains why their performance cannot be fully understood through traditional cyclical frameworks alone. What must be understood now is that this market is no longer negotiating direction, it is negotiating ownership. And that distinction explains why every attempt to compress prices back into old ranges fails faster than models anticipate. Ownership matters because it determines sensitivity to price. When ownership migrates from fast money to strategic capital, volatility changes shape. The amplitude may remain high, but the duration of drawdowns shortens. This is exactly what has been unfolding. Each wave of selling triggered by data or rebalancing mechanics meets a different kind of buyer than it would have 5 or 10 years ago. These buyers are not optimizing for entry perfection. They are allocating under constraint. Constraint-driven allocation behaves very differently from opportunity-driven speculation. Opportunity-driven capital waits. Constraint-driven capital moves when access is available. That is why silver and gold can absorb flows that would have overwhelmed them in prior cycles. It is also why commentary that frames volatility as fragility consistently underestimates what is happening beneath the surface. Fragile markets break when stressed. Resilient markets redistribute stress. Precious metals are doing the latter. The geopolitical backdrop accelerates this process, not by introducing new risk, but by reminding participants that old assumptions about stability no longer hold. Energy supply disruptions, regional conflicts, and trade realignments all feed into inflation uncertainty, but more importantly, they feed into planning uncertainty. Corporations, governments, and institutions cannot plan effectively when inputs, costs, and policy responses are all contingent. Planning uncertainty forces precautionary behavior. Precautionary behavior increases demand for assets that preserve optionality. Gold preserves optionality by existing outside credit systems. Silver preserves optionality while remaining embedded in production systems. That dual role is becoming increasingly valuable. It is also increasingly rare. There are very few assets that sit at the intersection of monetary hedge and industrial necessity. This scarcity of role, not just scarcity of metal, underpins the sustained bid. The rebalancing flows highlighted by banks are real, but they are mechanical rather than expressive. They do not reflect conviction. They reflect mandates. Once completed, they remove selling pressure rather than create it. Markets often misinterpret mandated selling as informed selling. The distinction is critical. Informed selling carries information about fundamentals. Mandated selling carries information about rules. Once rules are satisfied, the flow disappears. When prices fail to break, despite mandated selling, it signals that the underlying demand curve has shifted outward. That shift is not reversed by the completion of rebalancing, it is reinforced. Participants who were waiting for lower levels see that the window closes faster than expected. They adjust behavior accordingly. This adjustment is gradual, but it compounds. It shows up as higher lows, faster recoveries, and reduced follow-through on bearish catalysts. These are not technical coincidences. They are behavioral markers of a market transitioning into a different ownership regime. Monetary policy expectations interact with this transition in a non-linear way. Rate cuts used to be the primary driver of precious metals rallies because they directly reduced the opportunity cost of holding non-yielding assets. That relationship still exists, but it is no longer dominant. The opportunity cost framework assumes a stable policy environment where yield differentials are the primary decision variable. That assumption is weakening. When policy paths are uncertain and credibility is contested, yield loses explanatory power. What matters more is real purchasing power stability and counterparty independence. Metals provide both, regardless of whether rates are cut in March or June. This decoupling from precise policy timing makes metals less sensitive to disappointment and more resilient to noise. It also makes them harder to trade tactically. Traders who rely on clean reactions to data find themselves whipsawed. Allocators who accept ambiguity find themselves rewarded. This divergence in experience feeds back into market structure. As tactical traders reduce exposure due to frustration, volatility paradoxically decreases over time because the remaining participants are less reactive. This is another underappreciated dynamic. High volatility environments can evolve into stable uptrends not by calming sentiment, but by exhausting short-term participants. Exhaustion does not require capitulation. It requires repeated failure. Failure to break levels. Failure to sustain trends against the underlying flow. Each failure reallocates capital away from strategies that no longer work. Precious metals have been quietly inflicting this kind of failure on a range of short-term approaches. The result is not dramatic yet, but it is cumulative. Over weeks and months, it alters the composition of the market. The gold-to-silver ratio compression is one manifestation of this alteration, but not the only one. Lease rates, forward curves, and physical premiums tell a complementary story. They reflect a tightening of near-term availability relative to demand. That tightening does not have to become acute to matter. It only has to persist. Persistence changes behavior. When availability is perceived as consistently tighter, buyers move earlier. Moving earlier lifts the entire price structure. This is how markets reprice without obvious shocks. They do so through behavioral adaptation. The current environment is rich with incentives for such adaptation. Energy uncertainty increases industrial precaution. Fiscal stress increases monetary hedging. Political fragmentation increases policy risk. Each of these incentives alone would support metals. Together, they create a durable bid. The weekly gains observed are therefore less important than the weekly failures to retrace them. That pattern indicates acceptance rather than enthusiasm. Acceptance is more powerful than excitement. Excitement fades quickly. Acceptance endures. Once prices are accepted at higher levels, they become reference points rather than anomalies. This shifts negotiation upward. Sellers anchor to higher prices. Buyers accept higher costs. Volatility becomes noise around a new mean rather than a challenge to it. This process is uneven and often misunderstood in real time. Commentators search for catalysts when the real driver is adaptation. Adaptation does not produce clean headlines. It produces slow, relentless pressure. That pressure is now evident across the precious metals complex. It does not depend on one conflict, one data print, or one policy meeting. It depends on the accumulation of constraints that make traditional assets harder to rely on. As long as those constraints persist, precious metals will continue to be repriced, not because they promise returns, but because they reduce regret. In a world where errors are increasingly costly and reversals increasingly difficult, reducing regret becomes a primary objective. Gold and silver serve that objective in different but complementary ways. That is why their strength has persisted, and why attempts to frame it as temporary or purely reactionary continue to fall short. What becomes increasingly clear as this repricing advances is that the market is no longer anchored to equilibrium thinking. Equilibrium assumes that shocks are absorbed and systems revert. That assumption worked in an environment where buffers were thick, coordination was high, and policy credibility was broadly intact. None of those conditions describe the current landscape. Buffers are thin because leverage is embedded everywhere, not just in financial markets, but in public balance sheets. Coordination is weak because political incentives are fragmented across jurisdictions. Credibility is conditional because policy has become reactive rather than anticipatory. In such an environment, reversion is not the dominant force. Path dependency is. Once prices move to reflect new constraints, they do not easily return, because doing so would require those constraints to ease. There is little evidence of easing. Instead, there is evidence of layering. New sources of stress are added before old ones are resolved. Markets sense this layering intuitively. They respond by favoring assets whose value does not depend on the resolution of specific issues. Precious metals fit that profile more cleanly than most alternatives. This is not ideological, it is practical. Gold and silver do not require confidence in growth forecasts, earnings projections, or fiscal trajectories. They require only the recognition that uncertainty is persistent. That recognition has spread from the margins to the mainstream. It shows up in allocation behavior, not in rhetoric. Institutions rarely announce when they change their assumptions. They simply adjust exposure. Over time, those adjustments become visible in price resilience. The inability of gold to surrender its gains despite shifts in rate expectations suggests that the marginal buyer is no longer rate sensitive in the traditional sense. That buyer is sensitive to tail risk, policy drift, and correlation breakdown. Silver's behavior reinforces this interpretation. Its volatility is not a sign of weakness, but of transition. Smaller markets adjust faster. They overshoot, retrace, and overshoot again as new participants enter and old frameworks are tested. This is uncomfortable for short-term traders, but informative for those watching structure. The repeated pattern of silver underperforming briefly on data, and then outperforming on recovery, indicates that its demand is not being exhausted by higher prices. That is a critical signal. In commodity markets, price is the primary rationing mechanism. When higher prices fail to ration demand, it implies that demand is either inelastic or strategic. In silver's case, it is increasingly both. Industrial users cannot easily substitute away without incurring costs or compromising performance. Financial users are less price sensitive because their allocation decisions are driven by risk management rather than return optimization. This combination creates a floor that rises over time. Floors do not need headlines, they simply persist. The focus on near-term volatility obscures this dynamic. Volatility is not the enemy of repricing. It is the vehicle. It allows ownership to change hands without forcing a dramatic break. It gives late adopters opportunities to enter while gradually raising the reference level. This is why volatility that clusters around higher prices is structurally different from volatility that occurs at market tops. At tops, volatility expands as buyers retreat and sellers dominate. Here, volatility expands because buyers and sellers are both active, but sellers lack follow-through. That distinction matters. It suggests that supply is being met rather than overwhelmed. In gold, central bank participation adds another layer to this process. Central banks do not trade headlines. They rebalance reserves based on long-term considerations of currency exposure and geopolitical alignment. Their steady accumulation absorbs supply quietly. It does not spike prices overnight, but it reduces available float. Over time, reduced float amplifies the impact of incremental demand from other sources. This amplification contributes to the persistence of rallies. Silver lacks the same central bank participation, but it compensates through industrial anchoring. Governments may not stockpile silver directly, but they influence its demand indirectly through policy choices. Electrification targets, defense spending, and infrastructure investment all translate into silver demand regardless of price. These are not market-driven decisions in the narrow sense. They are political commitments. Once made, they are difficult to reverse without visible cost. That irreversibility adds weight to silver's demand profile. It also explains why analysts increasingly frame pullbacks as opportunities rather than warnings. They recognize that the supply response is constrained. Mining projects take years to bring online and require stable regulatory environments that are increasingly rare. Recycling helps at the margin but cannot offset sustained growth in demand. The supply side is therefore slow-moving, while the demand side is becoming more rigid. This asymmetry underlies the structural bullishness that persists despite tactical volatility. Monetary policy remains an important variable, but its role is shifting. It acts more as an accelerant or brake rather than a steering wheel. Rate cuts can accelerate inflows, but their absence does not necessarily reverse them. This is a subtle but important change. It means that precious metals are less dependent on policy easing than they were in previous cycles. They benefit from easing, but they do not require it. They respond instead to the perception that policy tools are less effective at managing the trade-offs they face. When every option carries cost, holding assets that sit outside the policy toolkit becomes attractive. This is not a vote against central banks. It is a recognition of their constraints. Markets respect constraints. They price them relentlessly. The upcoming data releases will be interpreted through this prism. A soft CPI may reinforce the narrative of eventual easing, but it will not eliminate concerns about fiscal sustainability or geopolitical risk. A firm CPI may delay easing expectations, but it will highlight the persistence of inflationary pressure linked to energy and supply chains. Either way, uncertainty remains. That persistence is the common denominator. Precious metals thrive in environments where uncertainty is not resolved but managed. They are instruments of management rather than speculation. This framing helps explain why their performance feels different from previous rallies. There is less exuberance and more acceptance, less chasing and more holding. These are hallmarks of a market undergoing structural repricing rather than cyclical rotation. As this process continues, the discourse around precious metals will lag reality. Commentary will continue to search for catalysts and explanations rooted in familiar frameworks. But markets move ahead of language. They adapt before they explain. The continued strength of gold and silver is not waiting for consensus. It is building it. Each week that gains are held despite narrative shifts brings more participants into alignment with the new baseline. Eventually, what now feels exceptional will feel normal. At that point, the question will no longer be why precious metals are strong, but what it would take for them not to be. That is a much higher bar. And it is one that the current environment shows little sign of meeting. At this stage, the market is effectively testing assumptions rather than prices. And that is why traditional signals feel unreliable. Investors are used to markets reacting cleanly to information, but when information is abundant and resolution is scarce, reaction becomes fragmented. Different participants respond to different risks on different timelines with different constraints. That fragmentation produces the uneven price action currently observed, but it also reveals something deeper. Consensus has shifted from direction to protection. When protection becomes the dominant motive, markets behave differently. They do not collapse easily, because selling itself creates the very conditions that motivate buying. This self-reinforcing loop is now visible in precious metals. Each dip, driven by mechanical flows, profit-taking, or short-term data interpretation, is met by capital that has been waiting precisely for such dislocations. That capital is not chasing momentum. It is filling perceived gaps between price and risk. The gap is not defined by valuation models. It is defined by exposure to systemic uncertainty. Gold and silver are being repriced as tools to manage that exposure. This is why attempts to frame the move as crowded or late repeatedly fail. Crowding implies homogeneity of motive. What exists now is heterogeneity. Some buyers are hedging currencies. Some are hedging energy risk. Some are hedging political fragmentation. Some are hedging correlation breakdowns. These motives overlap in the same instruments, but they do not synchronize. As a result, selling pressure rarely finds a vacuum. There is almost always a cohort stepping in for a different reason. That diversity of motive stabilizes demand. It does not eliminate volatility, but it redistributes it across time rather than compressing it into a single event. This is a crucial distinction. Markets that distribute stress tend to endure. Markets that concentrate stress tend to break. Precious metals are distributing stress. That process is reinforced by the way leverage is treated within the space. Unlike equities or high-yield credit, metals do not rely on balance sheet expansion to generate returns. They do not require earnings, growth, or financial engineering. Their price reflects marginal willingness to hold rather than projected cash flows. In an environment where leverage is already high and incremental leverage is increasingly scrutinized, assets that do not depend on leverage become more attractive. This is not a philosophical preference. It is a practical adjustment to regulatory and funding realities. Banks, funds, and corporates all face tighter conditions around leverage usage. That tightening does not reduce risk appetite uniformly. It redirects it. Risk is expressed through instruments that carry less embedded leverage and fewer counterparty dependencies. Physical metals and unencumbered exposure benefit from this redirection. Even paper exposure benefits indirectly because it reflects the pricing of the underlying scarcity. The ongoing focus on geopolitical uncertainty is therefore less about specific events and more about their cumulative effect on planning horizons. When planning horizons shorten, hedging horizons lengthen. This may sound counterintuitive, but it reflects the desire to stabilize outcomes over a wider range of scenarios. Precious metals serve that purpose. They are scenario agnostic. They do not perform best in one outcome and worst in another. They perform acceptably across many. That acceptability is increasingly valuable. It reduces the need for constant adjustment. In a world where adjustment itself carries cost and risk, reducing the frequency of adjustment becomes a form of return. This is another underappreciated driver of demand. Investors are not only seeking returns, they are seeking relief from complexity. Gold and silver provide that relief. They simplify portfolios by acting as universal offsets. This simplicity has value when systems are complex and interlinked. The energy dimension adds further weight. Energy markets are no longer purely cyclical. They are strategic, politicized, and increasingly subject to intervention. Price signals are distorted by subsidies, sanctions, and supply management. That distortion spills over into inflation dynamics, complicating monetary policy. Precious metals sit adjacent to energy without being consumed by it. They reflect energy stress without requiring energy input to generate value. This asymmetry enhances their role as hedges. Silver's energy linkage through industrial use ties it more directly to this dynamic. It becomes a proxy not just for monetary uncertainty, but for the physical reality of energy, transition, and infrastructure build-out. That proxy status is powerful because it aligns financial hedging with real-world demand. It reduces the risk that demand evaporates due to a shift in sentiment. Sentiment can change quickly. Infrastructure plans cannot, defense budgets cannot, grid upgrades cannot. These commitments anchor demand. When anchored demand meets constrained supply and uncertain policy, price floors rise. This is not speculation, it is arithmetic. The supply response cannot accelerate quickly enough to neutralize these forces. Even if prices incentivize exploration, regulatory hurdles, environmental constraints, and capital discipline delay output. The lag between price signal and supply response remains long. During that lag, price must do the work. This is the essence of commodity repricing. It is slow until it is not. It does not move in a straight line, but it rarely retraces fully once structural forces assert themselves. The current weekly gains are therefore less informative than the cumulative change in behavior. Participants are holding through volatility. They are not rushing to lock in profits at the first sign of resistance. This suggests confidence in the durability of the move, not in its speed. Confidence in durability is what sustains markets through consolidation. Consolidation at higher levels is constructive, not corrective. It allows new participants to enter without forcing existing ones out. That process expands the base. A broader base supports higher prices over time. The commentary that frames metals as reacting to uncertainty understates this transformation. They are not reacting, they are adapting. Adaptation implies permanence, reaction implies reversal. The distinction matters for forward-looking analysis. If this were merely a reaction, one would expect sharp reversals once headlines fade. Instead, what we observe is normalization at higher levels. Prices do not snap back to prior ranges. They oscillate above them. That behavior indicates that the market has accepted a new reference point. Acceptance is the final stage of repricing. It is quieter than discovery, but more consequential. Once acceptance occurs, debates shift from whether prices are justified to how exposure should be managed. That shift is already underway among institutional participants. It will filter into broader discourse with a lag. By the time it does, much of the repricing will have already occurred. This is how structural moves unfold. They feel ambiguous while they are happening and obvious in retrospect. The present moment is ambiguous by design. Multiple narratives compete. Data points conflict. Volatility persists. But beneath that noise, a simple reality is taking hold. The cost of certainty has risen, and assets that do not require certainty are being revalued accordingly. Gold and silver sit at the center of that revaluation. Their continued strength is not an anomaly. It is a signal that the system is adjusting to a higher baseline of risk. That adjustment is far from complete, but its direction is increasingly difficult to ignore. Capital allocation is increasingly driven by the recognition that the old hierarchy of signals has inverted. In previous cycles, policy guidance sat at the top, macro data followed, and asset prices adjusted accordingly. Today, prices are leading, data is lagging, and policy is reacting. That inversion matters because it changes how risk is assessed. When policy follows markets instead of anchoring them, volatility stops being a transient disturbance and becomes a structural feature. In that environment, assets that derive value from stability assumptions struggle to retain credibility. Assets that derive value from scarcity, neutrality, and balance sheet independence gain relevance. This is the quiet logic pulling capital toward precious metals. It is not ideological, and it is not speculative. It is procedural. Large pools of capital are not asking whether gold or silver will go up next week. They are asking what assets remain functional if correlations fail, if liquidity fragments, or if policy reversals arrive too late. These questions do not produce dramatic reallocations overnight. They produce gradual, persistent shifts that only become obvious after price has already adjusted. That is exactly the pattern now visible. Each attempt to frame gold and silver strength as temporary misses the deeper issue. There's no longer a clear mechanism to restore the conditions under which they would become unnecessary. Monetary tightening does not remove fiscal pressure. Fiscal expansion does not remove inflation risk. Energy normalization remains vulnerable to disruption. Supply chains remain politically exposed. None of these tensions resolve cleanly. They overlap. When stresses overlap, hedging becomes structural rather than tactical. That distinction explains why dips are absorbed rather than extended. It explains why rallies consolidate instead of collapsing. It explains why participation broadens instead of narrows. The market is not trying to outrun risk, it is trying to coexist with it. Silver S-roll within this framework deserves particular attention because it sits at the intersection of financial allocation and physical necessity. Unlike gold, silver is consumed. Unlike industrial metals, silver carries monetary history. This dual character creates feedback loops that are poorly captured by traditional models. When financial demand increases, it competes directly with industrial demand rather than displacing it. Prices rise, but consumption does not fall proportionally because substitution is limited. That creates persistent tension between availability and usage. Over time, that tension expresses itself through higher volatility around a rising mean. This is not a blow-off pattern, it is a compression pattern. Each cycle tightens the range of outcomes until a new reference level is established. Analysts who focus exclusively on ratio targets or historical analogs risk missing this dynamic because the structure of demand has changed. Electrification, digital infrastructure, and defense technology embed silver usage into long-term investment programs that are politically insulated. These programs do not pause because price moves against them in the short term. They are funded through multi-year budgets that prioritize continuity. That continuity anchors demand in a way that speculative interest never could. When financial flows align with that anchor, price discovery accelerates. Gold, meanwhile, continues to serve as the reserve asset of last resort in a system where trust is increasingly fragmented. Central banks accumulate not to express confidence, but to reduce exposure. This distinction is critical. Reserve accumulation driven by confidence is cyclical. Accumulation driven by risk management is secular. The latter does not reverse easily because the risks it responds to are structural. Currency competition, sanctions exposure, and payment system fragmentation all push reserve managers toward assets that are politically neutral and settlement independent. Gold satisfies those criteria uniquely. As this process unfolds, the marginal seller becomes harder to find. That scarcity does not always show up in headline supply numbers, but it reveals itself through price behavior. Pullbacks are shallower, recoveries are faster, breakdowns fail. These are not technical curiosities. They are reflections of ownership transfer. Strong hands absorb supply from weaker ones. Over time, that transfer changes the elasticity of the market. Once elasticity declines, price responses to incremental demand increase. This is why volatility can coexist with strength. It is not a contradiction. It is a symptom of transition. Attempts to attribute weekly movements to single data points or events underestimate the degree to which the market has shifted into a regime where narratives follow flows, not the other way around. Economic releases still matter, but they matter as confirmations or accelerants rather than drivers. A soft labor print reinforces an existing bid. A strong manufacturing report introduces friction, but does not reverse it. The direction is set elsewhere in the slow recalibration of what constitutes safety, liquidity, and optionality. That recalibration is occurring across asset classes, but it is most visible in those that sit outside the credit system. Precious metals do not promise yield, but they also do not demand faith. In an environment where faith is increasingly conditional, that trade-off looks less costly than it once did. The persistence of inflows, despite shifting rate expectations, signals that this logic has reached a critical mass. Once that happens, markets stop asking what would justify holding an asset and start asking what would justify not holding it. That is a profound shift. It does not announce itself with fanfare. It emerges quietly through allocation decisions, risk models, and portfolio constraints. But once it is in place, it is difficult to reverse because it is rooted in the structure of the system rather than the mood of the moment. Precious metals are not being repriced because the world is ending. They are being repriced because the world has become more complex, more constrained, and less predictable. Systems that grow more complex reward simplicity at the margin. Gold and silver represent that simplicity. They do not solve problems, but they do not compound them. In a financial architecture where compounding problems have become the norm, that attribute is increasingly valuable.